Now we have Manjit Singh and Kusum Ramachandran from Manjit Singh CPA PC with some tax tips.
Good morning, viewers. Thank you for tuning into this morning's edition of Tax Talk. My name is Kusum, and with me is Mr. Manjit Singh CPA of Manjit Singh CPA PC in Falls Church, Virginia. Mr. Singh, good morning.
Good morning, Kusum.
Recently, I read this long article in the Wall Street Journal about audits and how you can prepare yourself, rather how you can present your tax return in a way as to avoid them. And I was wondering whether you could elaborate for our viewers some of the highlights.
Absolutely, Kusum. I think you're mentioning to the Wall Street Journal article, which was there on January the 24th, titled 10 Ways to Audit-Proof Your Tax Return.
That is the one.
The very important and critical is choose your preparer wisely. Sure. And one of the things the IRS is doing is keeping a database of the individuals who are preparing tax returns. And you and I both have renewed our PTIN numbers in October, and believe it or not, we ended up paying fees to renew it as well. The IRS is going to keep tabs on the individuals who are preparing the tax returns. What kind of deductions those preparers are claiming. As we know, in the past, in our Washington metro area community, there have been preparers who have been specifically targeted, and their tax returns, their prepared tax returns were audited, and they were specifically looking for itemized deduction form 2106, where employee business expenses are claimed and the charitable contribution deductions are claimed or not. So if that kind of tax returns come or is prevalent, they're going to definitely look at the preparer. The other aspect is the PTIN number aspect is in June or July, they're going to be asking almost everybody other than CPAs, enrolled agents, and attorneys to take a competency test, whether they know the tax laws to prepare the returns. Because it's very easy to go and buy TurboTax software and prepare the return yourself, or somebody else who has a little experience using the software. It's just a matter of where to plug what number in there and the tax return will be churned out. TurboTax people, Intuit, the manufacturer, guarantees that the accuracy of the calculation, not where you put the information on each line. So it all boils down to donation to the temple is a tax deductible item, but a gift to an individual is not a tax deductible item. However, if you look at the line on Schedule A on the charity thing, it says donations, charity, gifts. So a person who says, oh, it's gifts, let me put it down there and take a deduction, it's not a tax deduction if you get questioned about it.
Yes, and also how about reporting all your income?
That's also very critical for people who are in cash businesses, dry cleaning business, taxi driving, people who get tips at restaurants. It is very critical that you report all your income. The element that you come across here is, you're the one who received the income. You need to be honest on your tax return and say, okay, I made $1,000. You may make a mathematical error. A difference of, let's say, $50 or $75 in a year is not a very critical issue. However, if somebody gave you some money for work done in 2009, in early 2010, wrote you a check for $500, and unawares to you, you moved, or you relocated, and they issued a 1099, you didn't get it. But the IRS received the 1099, so the IRS knows that there is an income issued to you, but you missed reporting it. And remember, if it's more than $600, it's subject to Social Security tax, and definitely the IRS is going to come and look at you. Even though this is a CP 2000 notice, unreported income, it's still an audit because the information you reported on your tax return and the information the IRS computer has not matched, and therefore you got a correspondence letter on it.
That's true. How about I'm told that there are certain forms that if you file them with your tax return, you expose yourself to audit.
The truth of the matter is this is not very often heard about, but if you have a business, sorry, not a business, but a hobby, in a hobby, what the IRS is expecting that you will not be allowed to claim a loss. If you have, let's say, $1,000 of income and you have $1,200 of expenses, you're supposed to stop at $1,000. You can do a Schedule C, claim $1,000 income, $1,000 expense, and zero net profit. You cannot make it $1,200. However, if you are in business and you want to preempt the IRS from auditing you, if I remember correctly, there's a Form 5213 that you put in there. And that form is kind of telling the IRS that this is a business and they are having losses. It's acceptable. However, after 5 years, the IRS computers is going to generate an audit to verify that you are actually in business. And don't be surprised if the IRS knocks on your door and says, hey, I'm from the Internal Revenue Service. I came to see if you are legitimately in business. If you have a commercial place where you're running the business, it helps you out a little, but if you are doing it out of your home, you may have a little explaining to do, and therefore I strongly suggest that you have a proper set of documents to prove to the IRS that you are in business and you are doing your very, very best to make a profit.
I think maybe we should go over some of the other things that will help you keep from getting audited in our next segment.
Okay. Folks, this is Manjit.
And I'm Kusum. Thanks for watching.